Hi, I'm Joy Wiltermuth, news editor and senior reporter at MarketWatch. I'm joined here today with Victor Jones. He's the head of global strategy at tastytrade in Chicago, and Liz Young, SoFi, head of investment strategy in New York. Welcome.
Thank you.
Thanks for having me.
So just before we start, I wanted to remind members of the audience, if you have questions for our panelists, please put them in the box and we will get to them. So to kick things off, inflation, high rising rates, war in Europe, all of this is roiling markets. So we're going to talk today about how to invest in this environment. To kick things off, the Federal Reserve's tougher stance on high inflation, what does that mean for investors? Victor, recently you tweeted about the Fed's last meeting saying, your interpretation of the Fed minutes were the Fed is saying either give up some of your 401k or some equity in your home. Is that the double-edged sword that investors face right now?
I think in a way, this is the first time I've been asked to defend a tweet in a public forum, so I'm going to do my best here. And I got to be careful about the things I say going forward. It wasn't a response to the minutes so much it was a response to Bill Dudley. He wrote an opinion piece, and I think it was on April 6th. The title of it was, "If stocks don't fall, the Fed needs to force them." At the time, I think the S&P was like 4% off the highs. The 10-year was at like 2.5%. Maybe 75 bips above where we were just a year ago. And the general point that he made, and I'm paraphrasing here, but he said investors need to listen to Jerome Powell more closely. Financial conditions need to tighten. And while that seems unlikely, the Fed will have to shock markets if it doesn't happen. He said one way or another, if stock prices don't fall and bond yields don't move higher, the Fed will have to effectively force the market's hand here. And so in a way, I was effectively paraphrasing what I was hearing, which are financial conditions need to tighten. And if not, the Fed doesn't necessarily have a scalpel, right? They have, this large mechanism that isn't going to do exactly what they want it to do. If you take a look at all the four major buckets of inflation, 15% weighted towards food, 8% weighted towards energy, 33% weighted towards shelter, and the rest is this big bucket. And I think, you start raising interest rates, you double interest rates on home purchases on a leveraged asset that's trading at nominal price highs, you're going to have an impact into demand of that asset. And if the Fed is forced to move aggressively above the neutral rate, well, that likely can have an impact on people's home equity. And so I feel like, in a way, Bill Dudley was telling the marketplace, and this is a former New York Fed president, he's telling the marketplace as directly as possible, if you don't tighten financial conditions, we're going to do it for you. And I suppose that's my best defense of that tweet, that they have the ability to reverse the wealth effect. They can't really change the fact that 25 to 30% of the world's wheat exports have a big question mark, or 15% of the world's corn exports have a big question mark, or 10% of the world's crude oil have a big question mark. They can't change the fact that companies are moving towards onshoring or nearshoring if they think that's in their best interest. They can't change the fact that governments might start to rethink their critical supply chains in the interest of national security. What they have is a mechanism to effectively reverse people's wealth effect and start to create demand destruction. And, so it was more a comment on Bill Dudley's statement than it was necessarily the minutes or the balance sheet or what was happening at the time.
Right. So that's starting from the top, the Fed. Let's get a little bit more into what investors can do in their portfolios. Liz, you recently wrote about the 60-40 classic portfolio construction. Talk about that a little bit, what it is, and is it dead?
Yeah, well, I want to circle back to the Fed comments a little bit first. So the Fed did pivot in November and really has been very clear about what they plan to do each meeting since then. And what we would expect in the May meeting is that we get another 50 basis point hike. And the intention here, as Victor correctly points out, is that they need to affect demand in the economy so that inflation can start to cool off. And we've tightened financial conditions slightly at this point, but we just began that cycle. So they're likely to continue tightening as we move through the year, which is necessary for inflation to be more controlled. The tricky part about the Fed is we don't know what neutral is. We don't know what the neutral rate is. It continues to be a moving target, and they know that too. So they're trying to chase a moving target, figure out where that neutral rate lies, and that's the experimentation along the way. Now, for the 60-40 portfolio, what's happened in the last few months is that the environment has changed. A 60-40 portfolio is traditionally 60% equities, 40% bonds. And that's what we as an industry had used as a baseline allocation to call it a diversified allocation. And what should happen in a perfect world is that if you have a drawdown in equities in that 60% portion, the 40% in bonds would protect you and it would move in the other direction. So it would offset the drawdown that you had in equities. What's happened up until earlier this year is that bonds had a 4-decade-long rally, which meant that both bonds and equities were at a point where they were poised to actually have a drawdown, especially in a rising rate environment. So when we talk about valuations, you can talk about valuations from a stock standpoint. And I think most people understand what that means. Valuations from a bond standpoint were also really high towards the end of last year coming into this year. So we've seen this huge correction in bonds. Now, the premise was that 60-40 was dead. And that was before we had this huge correction in bonds because they weren't going to protect stocks. It's true that stocks and bonds both went down in Q1. I will point out that that is a rare occurrence that does not happen very often. But now that we've got bonds at a place where they've corrected quite a bit, they've corrected more than stocks year to date. They're at a place where they could actually offer some protection. They're starting to look attractive again. And you look at the yield of a bond or a treasury bond in particular compared to a dividend yield on an S&P 500 stock, and they are actually starting to look more attractive. So my entire takeaway was that 60-40 is not dead forever. Should we put some alternatives in the portfolio? Absolutely. So maybe it's 60-30-10 or something of that nature. But the fact that bonds would be removed completely or that they don't have any utility in a portfolio anymore, I think is just false.
Great. Also, I want to hear a little bit about what you're hearing from clients. With inflation at 40-year highs, definitely it's painful. Are they frozen in time waiting for worse days ahead? Are they still transacting in markets? What are you hearing? Go ahead. Why don't you go ahead, Liz?
So when you think about what inflation means to the actual consumer, we talk about headline inflation mostly because it includes food and energy, and that's what bites into a consumer's checking account. As the prices of food and energy have risen, I think consumers have had to start making different decisions on what they're going to spend their money on. The other thing that's happened, as obviously the market has experienced volatility, is that you have a little bit of a slowdown in investor activity, or you have withdrawals from investor activity. And in reality, what we want people to do is remember the fact that what got you here won't get you to the next spot, especially as the environment changes. So it doesn't mean you stop investing. It means that you start investing in different things than what got you to this point, or maybe over the last 18 months or so. So no, I don't think that investors are suddenly out of the market. They're just a little bit worried about what they should be doing here and where they can find growth. I'd also point out that the investors on SoFi's platform do skew younger. So about 65% of the investors in our Invest product are between the ages of 20 and 40. And that age group tends to be more interested in growthy areas of the market. So things like technology, communications, disruptive stocks. They like the IPO market, right? And I'm painting with a broad brush. And a lot of those places have been hit hard. So it does hurt investor sentiment, but the answer is never to stop investing. The answer is to just shift what you're focusing on.
Okay, great. Thanks. And Victor, what about you? What are you hearing?
Well, our world is predominantly a derivative world. So people are generally in our world running higher cash levels, and they're effectively running short premium, option premium strategies. What that basically means is they're selling option premium. And if you look at exchange volume data over the last year, generally speaking, options or derivative volume grew, but it grew, at a 2 to 3% rate. And, in our world anyway, when you're dealing with volatility, volatility can be utilized as an asset class. Volatility is mean reversion. It's mean reverting. It's reliable in its mean reversion, whereas price is not. What I mean by that is, if a price was at a certain level 3 months ago, it's easy for an investor to look at a chart and say, because it was here, it's likely it can get back there in a 3 or 6 month period, and sort of disregard the idea that you're in a new volatility regime, you're in a new inflation regime, you're in a new monetary policy regime, not only domestically, but across the world. You're seeing inflation impact not just the United States. You saw that, German PPI this morning was somewhere north of 30%. So this is a global phenomenon, not just a US phenomenon. And in that environment, I think sophisticated options traders are utilizing increased volatility to sell upside against their existing positions, try to minimize the potential downside, or utilize some of that option premium to then buy downside put protection. I'm talking about, a zero cost collar. So our world is looking at ways to utilize options for risk minimization. There was probably a group of people who came along in the last 2 to 3 years who were introduced to markets in a world where, the cost of capital was cheap. And if you took some risk, the cost of risk was low. So you had the ability to ride out that risk to the upside. Now the cost of risk is accelerating to the upside. And what that means is people are paying a tuition for learning about macroeconomics. They're paying tuition for learning about narrative fallacy, for recency bias, for leverage, beta, and diversification. I think these are all good things. They are lessons that every investor of every age, of every generation ultimately has to learn in order to find success over the long term. And I think, inflation is the main topic of discussion today. I think it's good to put this in perspective. We have not seen this type of inflation in 4 decades. And so while there are a lot of investors who are likely nearing retirement who have gone through this situation before, largely for many people, the environment that they're facing on a day-to-day basis are things that they've only seen in textbooks or on Twitter. And I think knowing how to utilize higher volatility, knowing how to utilize the options world to minimize your downside, even in the equities world, I think is important. And I think sophisticated options traders are doing just that to try to minimize their downside risk through a highly volatile and uncertain period.
Great. Well, and speaking of options, more broadly, it's been unconventional times. We've had a pandemic, a lightning fast economic recovery, and now, as you've mentioned, the Fed is in there looking to sop up some of that massive liquidity that's been in the markets. What do you think? Is it time for unconventional investing? Maybe it's time for crypto, art, wine, other kinds of things that you hear about. What do you think, Liz?
I think that I like to drink my wine. I don't like to invest in wine. When you think about what are the unconventional pieces, you have to ask yourself, what are you using it for? And I think a lot of people look at something like art as a store of value that they can both enjoy while they own it and hopefully sell it for a higher price later on. That's something that locks up your money for a very long period of time. You buy a piece of art, you hang it on the wall, maybe you put it in storage. You don't get to use that for a long time, and you don't find out if it worked or not for many years. Wine, as I mentioned, that's a drinkable item, not an investable item for me. You look at things like crypto, and there's a couple different utility factors that you can think about with crypto. Some people do look at it as a store of value. It's a little bit volatile for me to call it that, but it is something that has a thesis around it that's really attractive, especially to younger and newer investors, and especially in a time when central banks seem to be ruling the roost on the equity market and the bond market. So if you can find something that is decentralized from that, or at least not correlated as closely to that, that's been an attractive proposition. Also, in an inflationary environment, you want to have other pieces in the portfolio that aren't going to be correlated maybe to the really volatile parts of the market, like commodities, especially during inflation. So some of it, I think, is worth a look. Other parts of it, not for me, but I think every investor is different.
Victor, what do you think?
I'm with you, Liz. I'd love to be investing in wine if I could stop opening those bottles. In a weird way, I would maybe push back on the premise of the question. I would say that over time, if you took somebody and you said, what's a diversified portfolio, right? It's not just having some money in tech stocks and some money in energy stocks. That's not a diversified wealth strategy over the long term. Inflation hedges have historically always been part of a long-term wealth strategy, whether you want to keep paper claims on gold or whether people have gold coins or gold bars or silver bars, whatever the case may be in their homes. Investing in art is likely not something you've traditionally done at the start of your wealth journey. It's probably been something you do as you're looking for additional diversification outlets. But today's financial innovation over the last 10 years has brought that closer. The ability for you to, invest in fractional ownership of art and these types of financial innovations are allowing people to get access to these types of diversification strategies much earlier in their investing life cycle. Should you be looking at all this stuff at the very beginning of your investing strategy? Maybe not. Maybe it's a lot easier to get caught in analysis paralysis than it is to just say, let me do dollar cost averaging in a passive index fund. But the reality is financial innovation is creating new opportunities for younger investors earlier along their wealth path to have a much more diversified approach to their money. To the crypto portion, diversification at the end of the day, I think it's generally taught and understood through the lens of a professional investor, right? Somebody who's got to remain fully invested at all times. So I'm rotating to staples when I want to get defensive, or I'm in healthcare. And I think there's a way to look at this. Just generally speaking, for the retail investor, you're looking for non-correlated volatility, right? You perhaps are not running these large amounts of capital, depending on who you are and what point in time you are investing. So what this means is, as an individual investor, you're just looking to put together a few pieces, a few assets that generally are as non-correlated as possible. And right now, I get the argument is that Bitcoin is acting like a growth tech stock. That's true in the short term. And I get that it's not necessarily acting like an inflation hedge. That's probably true in the short term. But with anything that has high degrees of volatility, you got to smooth out the vol. You got to smooth out the story and the narrative and look at it over a longer period of time. And if you do that with Bitcoin or with some of these different cryptocurrencies, what you end up finding is that over a longer period of time than just the 3 months that people want to sort of put this thing in a box, if you look at it over a longer period of time, it generally has lower correlation to other things you might have in the portfolio. And if at the end of the day, that is conventional diversification, I would sort of push back on the narrative that these are unconventional strategies. It's a new asset class that's just emerged over the last decade and a half. There's no doubt about that. But if the tried and true idea was to create a diversified portfolio, then adding non-correlated volatility is as conventional as we've ever seen.
Yeah,
Okay.
can I add a quick
Please.
point to that, to the diversification piece?
Yes.
So when you look at something like crypto, first of all, we don't have enough information yet, right? It doesn't have a super long history where we can look at it and say, this is exactly how it's supposed to act in this environment. This is exactly how it's supposed to act in this environment. That just doesn't exist. And we're still in the discovery phase. I mean, Bitcoin is now the least risky crypto, which is what people in the crypto industry would tell you. But the rest of us watching it as investors that have been in traditional assets are still not sure exactly how it's supposed to act at different times. So I would keep that in mind. The other thing I would keep in mind for investors is that in a crash or in a recession, two things go up: volatility and correlation. So you can have a diversified portfolio, and if you've got a period of time like we saw towards the end of last year, beginning of this year, where everything macro is not going right for the markets, you're going to have a drawdown that's experienced in most assets. And it's going to feel like nothing is working all at the same time. Those periods are usually very brief. In the rest of the periods that would be more normal, if you have non-correlated assets in your portfolio, it is not all supposed to go up at the same time. You are going to have portions of the portfolio that are doing well, and you absolutely should have portions of the portfolio that concurrently are not doing so well. That is the definition of diversification. You want the returns to move in different directions and behave differently over different environments. So if that's happening to you in a more normal environment, you're doing it right.
One last point that I would add, and it's a brilliant point by Liz about correlations going to one in periods of high volatility. The thing that I would add is maybe sometime around November, this theme accelerated. I would say it's been bubbling in sort of the background, not necessarily discussed more mainstream, but maybe November, I think BlackRock had a really good post at the end of November, and it effectively talked about the desire for real assets in an inflationary environment. And I think what we saw over the last year and what we continue to see in the first quarter of this year is a strong desire for real tangible assets. Whether that means in the short term, I'm looking for real cash flows. I'm not looking for future cash flows that low interest rates have effectively allowed me to run a really low discounted rate and high valuations. People are looking for real assets, whether that means gold, which is in the short term outperformed crypto, whether it means real estate, whether it means, value stocks or dividend paying stocks, lower beta. When the cost of capital goes up, people's risk tolerance goes down, and moving down the risk curve is a very rational response. You see, the 10-year goes up to 2.9 where we are now. That effectively means, to Liz's earlier point, when she says the 60-40 portfolio, did it make more sense when the long bond or the 10-year, the long bond is trading at 1.7, or does it make more sense when the long bond is trading at 3%? It's hard to want to believe in that 3% because you don't know if inflation is sticky at 4% or 5%. Because if that's the case, none of those numbers sound good. But if you believe that you're going to see moderation of inflation over time, then, what people have been doing as these yields are moving higher, they're saying, I can get a better yield by moving down the risk curve. And, it's exciting to want to go look at even a Netflix, for example, right? The question on every investor's mind is what is priced in and what is not, right? I think generally speaking, people are aware that inflation is playing a part into this marketplace. It's playing a part into rates, it's playing a part into assets, it's playing a part into style factor preferences. But what people are wrestling with right now is what's priced in is what's not. And I sort of feel like it's irresponsible to say that everything is priced in at this point. I think the gray swans are known and they're discounted to the effect that we could discount the first order effects. The second and third order effects are unknown, and I think it would be irresponsible to price them in fully. I think black swans are absolutely never priced in. You get a situation where Johnson & Johnson comes in and they say we are going to make $1 billion less. In perspective, that's only 1%, but we're going to bring in $1 billion less in this year, and the stock goes up $5. Where Netflix, on the other hand, it's bad news, not horrible news, it's bad news. Netflix tells you, not only do we not bring in 2.7 million subscribers, we lost 200,000 subscribers. So not only are we not one of those companies that people are looking at where I need pricing power in an inflationary environment, I'm now looking at you and saying, how can you raise prices even further than you have when you're having a hard time competing and keeping your pricing power where you are? And you see one of the FANG stocks being discounted for the second time by more than 20%. To me, that is a clear sign that you have risk that is discounted, but cannot be fully priced because it cannot be fully predicted. And I think for that reason, I think you have to be responsible and respect risk going forward in this environment.
Great. I want to go to one of the viewer questions that we've got. What's the outlook for large growth stocks? Do you think enough downside has been priced in? We just talked about that. Or do you think there's more headwind will be coming?
I'll start on that one. Given that we still expect a 50 basis point hike in May and maybe another one in June, I think there's still volatility to be seen in large growth stocks. However, that doesn't mean you shouldn't own them. And especially if you think that we're getting to later in the economic cycle and you want to be building positions in defensives in your portfolio, but you don't want to exit technology, large tech stocks do act pretty defensively when the market gets nervous. So that's a space that you can kind of balance out, having some growth exposure in the portfolio, but still also having something that would act a little bit more positively if there was a big drawdown or if there was a negative shock. So I don't think that it's all over. I do think that we're going to see relief rallies here and there as we hear more about inflation and from the Fed. but it's not something that I would exit. And I think technology is a classic sector that American investors should look at as the future of the US economy. And it's a place that you should always have some allocation. You just have to be careful about where you're buying.
Okay. Victor, one last quick one. Meme stocks, what's the future?
I think it's easy to classify what we saw with meme stocks as just this sort of function of lots of liquidity in the system. In many ways, I think I don't know that meme stocks are sort of this thing of the past, and I'll explain what I mean. It depends on your definition. Is a meme stock something with a low float and high short interest that gets squeezed to the upside? Well, in that case, I think you've seen those situations get much less publicity, play itself out in markets, for a long period of time. Do you look at what SoftBank did just a few summers ago, where they put billions of dollars in upside calls in Tesla, Amazon, Google, and Microsoft? Nobody cried foul when that gamma squeeze seemed to be playing itself out in some of those markets as well. So I think the definition probably evolves here. The fact that what Elon is doing with Twitter right now, I don't know that you call that a meme stock, but I think it depends on the definition. Is the definition something that seems like its price discovery its price discovery mechanism is broken? Is it just the fact that you could look at all these stores, you can see they're empty, but the price is going up hundreds of percent? I think the definition evolves, but as liquidity actually leaves the system, and you perhaps have nihilist investors out there that with something to prove, that don't necessarily care about gains or losses and are fighting a cause that whether you believe in it or not, that are rooted in market structure. I wonder if the lack of liquidity sort of leaves the opening for this to continue to play itself out over time. And I also wonder if our definition of meme stocks evolve over time. The SEC came out with their paper describing what they thought was happening during that meme stock phenomenon, said gamma squeezes weren't necessarily playing a part, but I think there have been some response letters that might have argued the opposite. And, if you believe that gamma squeeze dynamic continues to play itself out, I don't know that these are a thing of the past.
Okay. Thank you so much. Thank you, Liz. Thank you, Victor. We're going to have to leave it there.